We are now going to be looking at movable assets. So basically, as the name suggests, assets that you can move. Computers, furniture, motor vehicles, and so forth. Also things that is attached to buildings, for example, like an air conditioner. I know it seems attached to a building, but you can obviously take it down. Right. So movable assets. Very important section in your syllabus, one that you will definitely see quite often. Right, also very, very popular when it comes to things like recoupments. Now, in this section we are going to be looking at section 11E, which is the section which is applicable to movable assets. So remember, section 11 is where all our deductions sit. So this is a deduction, but it's a capital allowance at the same time. Now, important guys, this section is not available to immovable property, so buildings, at all, ever, ever, ever. Don't be tricked there, don't get caught out. Part of this section, what you need to know is that you need to know that there's a lot of rules contained in Interpretation Note 47. So what I want you to understand before we now start climbing into all of this is that the SARS has issued an Interpretation Note 47. It was issued a number of years ago, so you'll see there's sections, there's some references in it. For example, this reference to section 23J, which you can ignore. But you'll see there's a couple of rules here which I'm going to discuss, which you are not going to see when you look at section 11E in the Act. So if you want to read those rules to see where they come from, that's an Interpretation Note 47. Okay, so let's start talking about wear and tear. In simple terms, wear and tear works very similar to how accounting's depreciation works. So basically what will happen is I'll say you buy a computer. It has a cost of, let's say, 9,000 rands, and they'll tell you in the question that SARS allows you a write-off period, and they'll tell you that write-off period, they'll tell you it's either in terms of Interpretation Note 47, right, or Binding General Ruling number 6. They'll make some sort of comment, but basically they'll give you the write-off period, so whatever it is. So let's say they say the write-off period is 3 years. It's the useful life of the computer. So the same way that you go in accounting and you have a useful life, SARS also has a useful life for some of his assets. Now basically in just a nutshell, they will tell you what the write-off is, but in reality how it works is SARS has issued a list and they'll say computers have a useful life of 3 years. Now you can go to SARS and make an application if you disagree or you want a short or a longer one, but you'll have to substantiate your reason why it might be. So maybe the asset that you are using takes a lot more wear and tear than the average asset does, maybe the environment, and then you can go and justify that to SARS and they might allow it. Okay, so understand, just for your purposes, for exams and so forth, they will provide you with it. Now, this write-off over 3 years, in simple terms, what will happen is the following. I'm going to show you. Year 1, you will do the following calculation. 9,000 divided by 3 times 12 over 12. So there's a couple of things there which I want you to see. You apportion it. Okay, you must apportion. Now guys, most of the capital allowances don't have apportionment. So this one you need to apportion. So what does that mean? It means if you used it for 7 months, then you would not have said times 12 over 12, you would have said times 7 over 12. Right, so you apportion it. Okay, so that's what I want you to see over there. That gives us a write-off of 3,000 rands. I just want you to see what this, basically the principle. Same thing for year 2. How long did we use it? We used it the entire year, and so forth. Now I just want you to see in year 3, one of the special rules here. We're looking at this rule here where they talk about a value of 1 rand. When you finally write it off, when you are done writing it off, so in the final year when it is being written off, the last time that you're writing off, you will calculate the allowance, but you will deduct 1 rand from it. So basically the allowance for this year will be 2,999. So if I add it up, the total allowance is 8,999. That's the total allowance. So What does this mean? It means if we take the cost of the asset, 9,000 rands, and we say less the allowances that were claimed, 899, that calculates an amount, guys, and this amount is an important amount for you to understand. This is called the tax value, and you do use this when you're calculating things like recoupments and so forth. That tax value is then 1 rand. So, when you are looking at wear and tear under section 11E, and that rule, what I just discussed there, is discussed in Interpretation Note 47. They tell you that you need to write it off to 1 rand. Basically, this is just, and it's a bit of an outdated way, but it's still relevant. It's basically just a way to make sure that you have your fixed asset register, you have a fixed asset register for tax as well, you should, that's encouraged, that asset is still shown there as 1 rand. Because if you go and you sell this computer at a later stage, that 1 rand means that you have to remove it from your fixed asset register or your tax asset register, whatever you are using, you have to remove it from there. So it reminds you to go and do a calculation, because if you sell it at a later stage, you'll have to calculate things like recoupments and potentially capital gains. So, very, very important for you to understand. The final year, when you do this calculation, you deduct 1 rand from it, just in the last year. Now, please understand, you deduct the full 1 rand from the last year. I know it's a little bit strange, because the way it should be, if you think about it, should be to say 9,000 minus 1 rand divided by 3 times 12 over 12. This is how you do it when you have a residual value in financial accounting. But because 1 rand is such a small amount to split over a number of years, they just deduct it from the final year. Right, that is per Interpretation Note 47. Then, guys, another rule, if the asset does not cost more than 7,000 rands, and remember that's the cost for tax purposes, so the cost excluding VAT, if you could claim VAT. If it costs no more than 7,000 rand, so if it's 7,000 or less, then you can claim the full cost immediately. So, let's say you buy a computer that has a cost of 5,000 rands, and that's now X VAT, so you could claim the VAT, and the useful life from SARS's perspective is 3 years. In this case, in year 1, when you use it the first time, you can claim the full amount, but minus 1 rand. So you can claim 4,999. Right, guys? Very important there. Then, our next rule. This rule about this apportionment that we spoke about here. So how do you apportion it? Right, if I said here you use it for 7 months, you say times 7 over 12. Now, what is important for you to understand here? In financial accounting, you start doing your depreciation from the moment that it is available for use. So even if you're not using it, if it's available for use. But for tax purposes, it is only when you are bringing it into use in the production of income. So what does that mean? Let's say this taxpayer has a December year end, right? You buy this asset on the 1st of Jan, you buy it, but you start using it from the 1st of June. Then you would have used it for 7 months in the year, times 7 over 12. But it might be available for use from the 1st of Jan for accounting purposes. We don't care about accounting in tax. Okay, then, that's now the calculations done. So now just a couple of general rules around what you need to be aware of, a couple of things. You need to understand that section 11E, this calculation, is calculated on the value of the asset. Now, this 9,000, that's what we're referring to. That's the value of the asset. Now, most of the time, the cost of the asset will be the value of the asset. Because most of the time in questions, guys, and in real life, you see things at arm's length value. So you need to be careful if things are not at arm's length. You can claim it on the value of the asset. Now, what is very important for you to see here is the following. If the asset did not have a cost at all, so you didn't pay anything for the asset, so someone, for example, donated it to you, or you inherited it from someone. Just remember, natural persons can also have this if they're using this asset. So, then it doesn't have a cost. You can still claim this wear and tear allowance. So they'll say to you, Mrs. X passed away and Mr. A inherited her laptop. Right, the market value at that time was 9,000 rands. And let's say there was the remaining useful life, you do the same thing over here. Right, whatever the case may be. So you'll use the market value of the asset. Very important, guys, because, and pay attention to that, because you'll see when you look at the other capital allowances, that rule does not apply. In all of the other instances, basically, you need to have a cost to the asset. So if you don't have the cost to an asset, you can't claim it. Then, please be aware also, guys, that you might go and buy something like a manufacturing machine. Now, a manufacturing machine can be a movable asset, but a manufacturing machine qualifies for a special allowance under Section 12C or under Section 12E if you're a small business corporation. Now, why am I saying this to you? Because a wear and tear asset, right, so you might buy an asset and it might qualify for both Section 12C and it might qualify for wear and tear. Now, what they do in exams, I'm just warning you, is they'll tell you, and most students know rules like this about manufacturing machines. So they'll say to you in an exam situation, you X Limited buys machine X, it's a manufacturing machine, and then you know it qualifies for Section 12C. But then the examiners include a comment saying, per interpretation note 47, which is this one we're looking at here, or binding general rule number 6, whatever, but per this information, this machine has a useful life of 6 years. And now you're stumped because you initially thought that you would have to use Section 12C, but why are they giving you this information? Guys, you need to know in an exam what to use. They can and they will give you information which is not relevant to you. You need to know what is relevant, because all of this information, if you go out into reality and real life, you also have all of this information available to you. You need to know what's relevant and what's irrelevant. So this is a skill that they're trying to teach you. You need to know that you should then not use the wear and tear section, but you should use Section 12C. So that's how you should study, guys. You need to know what the rules are. Not, I need to know how to answer a question. If they give me this and this information, I need to do that. That's not how it works. You need to know what the rules are. Then, guys, please note, if this machine has to be attached to a foundation, maybe it's a big machine that needs to be attached to something, that forms part of the cost of the asset. If the asset has to be moved after it has been bought, this is important for you. So, let's say you buy an asset, it has a 5-year write-off period. So year 1, 2, 3, 4, and 5 is going to be written off. Right, what I want you to see is, let's say at the end of year 3, you move this asset out of your factory and you move it to another factory. So this asset had a cost of 100,000 rands, and now you incurred moving costs of 20,000 rands. That moving cost first there is a capital expense. You can't claim a deduction under the general deduction formula. It relates to the capital structure of this business. It's an enduring benefit, right? Because you've moved the asset from one location to another, right? It relates to the cost of the asset. That capital, that moving cost, you will then write off over the remaining period that is left for the rest of the asset. So you'll say 20,000 divided by 2, basically. If you moved it, let's say in year 8, after this asset has been fully written off, then you'll just claim the full 20,000 rands immediately. Same thing, guys, with a capitalized improvement. So you bought a machine for 100,000 rands. At the end of year 3, you put a new engine on the machine, for example. Right? So let's say it was a car and you put a new engine in it. That's a capital expense. You can claim it over the remaining useful life. So basically what they're trying to stop here is they don't want you to say this asset has a useful life of 5 years and then you put a new engine in which has a useful life of 8 years, and then you have to depreciate part of the machine or write off part of the machine after its main useful life has passed. They don't want you that. So they're basically saying, we want you to just do it over 5 years. So make sure it ends at 5 years. If you incur costs afterwards, claim the full amount. If you incurred in year 5, also claim the full amount. Right. In that way. That's it for section 11E.